Have you ever attended an economic conference in your city? Talk about the gentlemen and ladies in polished suits, the relative serenity of the environment and everyone seated, looking refined and civil. It all looks good until the speakers begin. You start taking notes, and then a few hours into it, you get really depressed. This is the case with economists, where it seems like all they ever do is predict doom. But are they ever right? Or is there something they are hiding from the public? You will find out in this video. Interestingly, the most common criticism of economic predictions is that they are usually wrong. From a literal perspective, this is, of course, true. Because, well, economists cannot claim to get things exactly right every time. However, from a general perspective, this proposition is wrong. Sometimes economic variables are forecast to a reasonable degree of accuracy. The Organization for Economic Cooperation and Development and Data Resources, Inc. have done a great job in this regard, proving to be some of the best international economy forecaster available. Over the years, their economic predictions have been astonishingly accurate on the surface. Judging by their performances, it is hard to see why there should be any skepticism about the efficacy of economic predictions, whether they are positive or negative. Unfortunately, there is usually more to the story than economists make it seem. For example, GDP is one of the easiest variables to forecast. Even though economists take pride in their GDP forecasting ability and, to a lesser extent, inflation, businesses still often have greater need for forecasts of more specific variables. These specific variables include components of GDP, such as house building, and key prices such as interest rates, exchange rates, and commodity prices. In these areas, the forecasting record is poor and generally ineffective. Also, because these forecasts are usually 1 year ahead, business owners often plan ahead according to the forecasts and end up bearing the consequences themselves when the economy doesn't play out as predicted. Even though this happens, almost 80% of economists have already predicted a recession the following year. Also, according to the National Association of Business Economics, more than ever, there is less clarity than usual about the economic outlook. With soaring inflation rates, gas prices, and an ongoing housing crisis, the American economy seems suspended in what some economists think is an unavoidable future, a recession. According to a recent survey by the National Association of Business Economics, 72% of economists expect a recession by the middle of next year, with 19% saying it may have already begun. What could trigger the recession? Usually, a recession emerges from a confluence of different negative factors that refuse to improve. For example, the Great Recession of 2008 emerged from a housing market collapse that was fueled by insufficient regulations, low interest rates, and subprime mortgages. Today, the economy is in a fragile state with ongoing supply chain constraints that have in part fueled high inflation, which has subsequently hiked up the cost of living, affecting other economic forces such as housing and the job market. In June 2022, when inflation hit record highs, the Fed raised interest rates by 0.5 percentage point, then again in July to 0.75 points in an attempt to tame inflation. However, interest rate hikes by the Fed often affect the larger economy, as higher rates tend to negatively affect stock prices and earnings, which can trigger an economic downturn. In an interview, Princeton economist Alan Blinder said that the Fed slows the economy down by raising interest rates, which cuts spending, and that if too much of that is done, a recession is inevitable. It is rather amusing that in these times, economists seem uncertain even in their pessimism. Let's see what other economists think. A survey featured responses from 198 economic analysts, where economists were asked how confident they were about the Fed's ability to tame inflation to its 2% goal in the next 2 years, without triggering an economic downturn. Only 27% of the respondents said they were confident, somewhat confident, or very confident that inflation could be controlled without causing a recession. The other 73% marked that they were not very confident, or not at all confident. This signals that the state of the economy remains uncertain, with the Fed chairman Jerome Powell stating at a policy meeting that it is difficult to confidently predict how the economy will be in distant months, and even years, adding that these times are not normal times. you may wonder why it is so hard to state whether we are in a recession or not. The reason is that while the economy has shrunk in the past years, the job market remains strong, with jobs in hundreds of thousands added every year, and retail spending shooting up over 10.1% the previous year. These conditions continue to confuse economists, putting them on opposing points of views, making them argue about whether we are already in a recession or the recession is still in view. In spite of the consistent pessimism of economists, the reality remains that the economy isn't doing as poorly as they make us think. This is due to a phenomenon known as second-hand pessimism. As the economy continues to suffer from high inflation, we see a paradox emerging. Individuals and businesses report feeling bad about the economy, yet they are still spending and making new investments. We call this divide between how consumers say they feel about the economy and their response, which is, still having money to spend, second-hand pessimism. Usually, when consumers don't feel so good about the economy, they tend to pull back on spending. But in the latest data, consumer spending has begun to rise more than inflation, and retail sales spending on goods at physical and online stores, bars, and restaurants are growing at the same pace as the high inflation, which remains near a 40-year high of 8.2%. A similar situation holds true for business owners. Businesses of all sizes, sectors, and industries report feeling pessimistic about the future of the economy, yet they continue to hire, raise wages, and make new investments. And surprisingly, they don't look like they will run into a loss doing so. Also, according to the U.S. Chamber Middle Market Index, despite 2 consecutive declines in quarterly gross domestic product in the first half of 2022, business conditions appear impressively resilient when looking ahead. While 48% of the middle market executives surveyed said gross revenues increased in the current quarter, 60% stated they expect them to improve over the next 6 months. Half also stated net earnings improved in the third quarter, with 59% indicating they expect improvement in the near term. When looking at small businesses, we see similar trends. In the third quarter of 2022, small businesses said the U.S. economy is in poor health. In fact, the number of small business owners and decision-makers saying the economy is in poor health is now more than twice as much as those saying it's in good health. However, small businesses have continued to grow at a good pace, contributing to second-hand pessimism. According to the Conference Board's survey of CEO confidence, 44% of CEOs expect to expand their workforce the next 12 months. 85% expect to increase wages by 3% or more over the next year. And 86% expect their capital budgets to increase or remain the same over the next year. These figures are contrary to the pessimistic forecasts of renowned economists. Now, what does this really mean? This doesn't mean to say that the economy is at its best, or that there aren't significant risks. Yes, the economy is doing well, considering all the resistances it faces right now, such as high inflation and workforce shortages. While it may grow between 1% and 2% in the second half of this year, the chances of a recession in 2023 are still significantly elevated, relatively because of high inflation and the rising interest rates that are necessary to bring it down. Looking at these factors, businesses and consumers are right to convey at least some pessimism. However, consumers' individual ability to keep spending, driven by a strong labor market and high savings levels, and businesses' willingness to continue hiring, raising wages, and investing, means the U.S. could weather the coming economic slowdown better than previous downturns. Whether that keeps us out of a recession altogether or makes a recession much lessen the toughness of the inflation if it occurs remains uncertain. Either way, it means the potential economic slowdown may not be as bad as many fear it could be. Bottom line is, inflation remains the biggest problem for the economy. Yes, even though prices remain high, consumers are still spending. Even so, economic fortunes can change quickly, which means consumers could stop spending at strong levels, and businesses could change their hiring and investment plans to fit economic pessimism. But for now, it's a good sign that the pessimism is second-hand, where it can cause much less trouble. Even though the economy has some negatives, it has become commonplace for economists to exaggerate the negatives and understate the positive forecasts. That's it. What economists are not telling you? We would love to hear your comments on the comments section. Also, please like this video. See you later.